In this video, you would find out the three different kinds of loan programs, namely FHA, which stands for Federal Housing Authority, VA, or Veteran Administration, and conventional loans. First is the FHA loan. Under this program, the minimum down payment is 3.5%. You need to have a minimum credit score of 620, and the maximum allowed loan amount varies in different areas, so just call or email me on this. However, in Clark County, Nevada, the max is $400,000. Now, since FHA insures the loan, in the event the borrower defaults on the loan, they collect an insurance premium, and this is collected in two ways. Look at the example here. One is an upfront mortgage insurance premium equal to 2.25% of the loan amount, and this is collected in cash or added to the loan amount. Most people add it to the loan amount. You would also be paying a monthly insurance premium for a minimum of 5 years. This premium is calculated by taking 0.55% of the loan amount divided by 12 months. You would pay this for 5 years or more until you reach 78% LTV. LTV stands for loan to value. Say you owe $80,000 and your house is worth $100,000. $80,000 divided by 100 is 0.8, or 80% loan to value. Now, unless you're a veteran or you're putting 20% down or more, I generally recommend FHA to my clients because of the outstanding rates and the low down payment requirement. The next option is VA, or Veteran Administration, and this program is available for veterans or active duty military personnel. There is no down payment required, and we need a minimum credit score of 640. Now, depending on where you are or where you live, the maximum loan amount ranges from $417,000 to a little over $1 million in some counties. Now, the VA doesn't have a mortgage insurance like FHA, but they have a VA funding fee. This is required by law, and this VA funding fee is paid to the VA for guaranteeing the loan. The chart on this page explains how much the funding fee is, depending on how much down payment the veteran is putting as down payment. Last are conventional loans. There are two types of conventional loans: conforming or non-conforming. Conforming loans are loans that follow the terms and guidelines set by Fannie Mae and Freddie Mac. What are those, or who are those? Fannie and Freddie are government-sponsored enterprises, and they purchase the residential mortgages on the market. On the other hand, a non-conforming loan is typically a jumbo loan, and this could range from over $400,000 to $2 million, again depending on where you live. I generally recommend a conventional loan if you intend to put 20% or more as down payment. See, doing so, you eliminate having to pay those mortgage insurance premiums. Also, if you intend to buy a second home, an investment property, or you're buying a house that would require a jumbo loan, then a conventional loan is a way to go. Thank you.